But thank you all sincerely for coming. Really do appreciate it. Especially making it in the snow. I was literally just telling Corey on the way over, I'm like, I thought I was supposed to stop and like maybe give a break or whatever. Glad y'all are here. And realistically today, like, yeah, I'll go over some stuff. I try not to be very PowerPointy. I will like hit some big stuff, but realistically, my hope is that we can kind of generate a more organic discussion on stuff that's important to y'all. And again, want to make myself available, answer any questions. We also have some partners in the room who are affiliated within the industry that can also help in terms of on the investment side, more like traditional marketable securities, also insurance. So pretty cool like wealth of knowledge that we've got in here. And I'm kind of digging the fact that it's kind of a smaller environment too. So again, pretty low key. If anybody has any questions along the way, feel free to stop me, but I'll just kind of launch in and go from there. So again, obviously, and again, thank you, Corey, of course, for inviting me and kind of hosting the space and everything. I appreciate, again, everybody being here. But so this, I kind of structured this to be like talking about from when whether we're talking like you're just starting out, you've never invested before, and you want to get in. So again, we can talk about all the way from like first-time home buyers, all the way on up to your more experienced investing and everything in between. But so I wanted to start by kind of illustrating the importance. And I know I probably don't have to preach a whole lot on this topic, but I just really like that. I love to hit this stat a lot. Homeowners' median wealth, 89 times that higher of renters. So again, we all kind of preach talking about renting versus buying, why to buy, why to rent. In the long term, there is, and again, this is just one of many, many, many statistics that we can throw out and you can research yourself. Again, buying is ultimately going to lead to just greater wealth over time. And again, the other thing is talking about the equity. So for 80% of Americans right now, 63% of their net worth is in the equity of their primary home. So I'm actually dealing with a few different situations right now where, again, it's later on in life. Obviously, folks are in their 70s and 80s. They don't really, frankly, have a lot of wealth in, again, the traditional marketable security side. They tried saving for retirement, but frankly, it's just, they're in a position where they're going to outlive their money, and they're getting to that point where equity is their only option. So if we can prevent something like this earlier on, where we have, again, a more diversified approach, get more real estate involved on top of that, that's really where we get a nice little balance between the two, and hopefully don't run into a situation like that. And again, nice little NAR quote, or the National Association of Realtors, homeownership leads to significant wealth gains over time. That's about as plain Jane of a quote as you can get, and I still very much appreciate it. The last thing I'll kind of hit, just to really belabor the point here. So that blue line is just, so if you purchased a home at about $500,000, again, we're in this example, this is obviously just a theoretical example. We're kind of, obviously every micro market is going to be very different, but overall, let's just assume a 4 to 5% growth in the value of your home. But the green is the equity. And the reason why that's going on worse is because obviously you're paying down that, you're refinancing it, hopefully getting into a lower interest rate, things along those lines. And again, your equity is really what's giving you that financial freedom, or at least I should say a piece of that financial freedom, again, over time. The other thing is we'll also go ahead and actually quick talk about, and this is part of the kind of the somewhat of the house hacking strategy that we'll talk about a little bit, but purchasing in places that you actually desire to travel to. So, I mean, finding destinations that you want to be in and buying homes there so that you can utilize those when it's your turn to play. So the first rule of just a motive of, now again, this is much easier said than done, but when it comes to investment, because again, this is kind of different than buying your primary home for the first time. I really try to emphasize this is more of a business decision than it is a personal or emotional decision. Obviously, with your primary home, there's clearly a lot of emotions involved. You're going to be living there. You're trying to visualize growing a family here. There's much more emotions involved. Whereas Investment, I try to think of it as, again, more of a stepping stone to whatever the next thing is, or at least a stepping stone to your financial freedom. And that really has more to do with numbers than it does, again, the emotions of, oh, I love this type of thing or that type of thing. Again, easier said than done, and maybe there is a balance of the two, but just something I really want to, at least for my clients, and this is something I would suggest kind of painting for your clients, is building that idea of a compelling future. That's what, again, gives us hope and gives us interest. So again, I'll start with kind of more of the first, so kind of, again, starting more on that beginning stage and kind of working our way up. So that house hacking strategy. So when you buy house number one for the very first time, utilizing a first-time home buyer program, just trying to get the least amount down. And again, finding these specific things that you're looking for within the house. So I'll start with, again, under buy house number one, finding, like, again, those spare rooms that you could potentially place a renter into. And then with your income, part of the strategy that I talk about with my clients is, how do we want to structure our loan? Do we want to structure it so we try to get paid more into the equity side, try to get that principal down? Again, that's really where we look at more of the strategy. But then again, also finding what I like to call rental hubs. So folks where like traveling nurses is a big one that even just recently talked about with a client this week about finding those hubs where these folks will be. So again, near hospitals and things like that, near universities, trending neighborhoods, and then also just finding places that are very investor friendly. So like, for example, Nashville, Tennessee, and different places around like Chattanooga is a great place for something like, again, something like short-term Airbnbs, anywhere where you can find places where the local laws are going to work more in your favor. That again is kind of more along that strategy. But again, when you're starting out for that first time, that minimum down payment, possibly looking as time grows over, you always want to set up your home equity line of credit. And again, we'll kind of talk about that HELOC too, while you are still in the home. That is it's the best way to take equity out of your home for potential use for the future, but then also potentially look at, ways that you can look at other options and ideas there as well. The other thing is we can use short-term rental income now, but we have to see a 1-year history.
It's only 1 year now?
Yeah, it's only 1 year. Correct. Yeah. So, and it depends on the investor. This isn't just like a general guideline, like everybody's going to do this. But we do have, so as a broker, we've got over 52 different investors and lenders. But it has to show up on VRBO or Airbnb for at least 1 year, and you have to file tax returns with that income in there. So as long as we can see 1 year tax returns with the short-term rental income in there, and it's been on VRBO, we can start using that short-term rental income. So that's something that, again, I'm getting into that strategy to qualify for house number two. So that's really where you start looking at that. So I'll kind of start with this one. I wanted to emphasize more of like the long term, because obviously we kind of have long-term strategies and short-term strategies. Sometimes you're going to do a little bit of both. It just really depends on the individual appetite and for your clients and what they're interested in. So obviously that long-term passive income, very, very important. Now, conventional options, we do have conventional options. Those are going to be your best pricing, your best interest rates are going to be with that. But it's also going to be the most paperwork. So again, we're going to want to see tax returns, W-2s, pay stubs, 1099s, all that good stuff. I will say there are going to be some things that are coming down the pipe that are actually just starting to hit right now. Because traditionally it's always been roughly 20 to 25% down for those conventional options. Now, if you're able to get up to 30% down, you actually get some really nice pricing breaks. And when I say pricing breaks, that means the cost for the interest rate is now becoming a little cheaper. And that's just starting to come into play now for some different things that are being rolled out. So I'm noticing that Fannie and Freddie, so our big government-sponsored entities, they are becoming a little bit nicer when it comes to the conventional space on investment properties. But again, as long as we get up to that that 30% down. The other thing, and then, so again, that's more of your conventional space, or what we call the agency space. On the, what I like to call the more creative side. So these are things that, like for example, the DSCR, that stands for debt service coverage ratio, which all that is just lender speak for, we're not going to look at your income, we're not going to look at other properties you own. We're going to solely look at the income from the property you're interested in, and making sure that that income offsets the mortgage liabilities that come with that property. So whatever monthly payment comes with that property, as long as we can get it offset by that rental income, that is what we'll use to qualify. So we're not going to look at anything else. We will do a credit review and an appraisal, but beyond that, we're not asking for, again, W-2s, tax returns, 1099s, none of that stuff. So that's more on that side. And so again, if it's harder to demonstrate income, or if you prefer to, frankly, not give a bunch of paperwork and save yourself some time, that helps too.
Is that actual income or potential income?
So the way that income gets evaluated is if it's an existing property with a lease on it already, we can use that lease income, or we can do what's called a 1007 appraisal. So that appraisal will give that long-term, so the appraiser not only gets the value of the property, but then a value for a marketable rent for that property. But again, it's going to be long-term lease. They're not going to evaluate short-term rental income or anything like that. They're just going to be looking at long-term. So what would that property be expected to rent for a 12-month lease? So is there another? Yeah.
So in a scenario where the person is already renting the place, but they're renting it under market value, by quite a bit, how do they take into account that? Do they take into account what market value is and what it could rent for, or what the previous tenant has been renting it for under market value?
That's a great question. We would take the higher of either that, again, that 1007 appraisal or that type of appraisal where we get that marketable rent, or whatever the existing rent is. We'll take the higher of the two. So yeah, we'll take whichever one's higher to offset for that. But yeah, that's a great question.
Is there a minimum down on the DSCR?
So the minimum down is 15%, but since I'll just be candid with y'all, at 15% down, you're not going to like the pricing. It's basically like just a shade behind hard money on that one. Ideally, I'd like to get it to 20 to 25% is where the pricing starts to make sense, and the actual income starts to make sense too, like in terms of cash flow and things like that. Because prior to that, it's tough to make the numbers work in terms of margins. Yeah.
Can you explain what you mean by hard money?
So hard money would be, that's a great question. So all these things that I'm going to talk to you about today, by the way, just are not hard money. So that, just to be clear on that. So in terms of just the lending world in general, and I'm kind of like giving a 30,000 foot view, but your best pricing and interest rates are going to be your conventional FHA, VA, USDA, or what we call agency options. The next level up is, again, these what I call creative, or we call the non-qualified market. So that is something we're not getting a government guarantee. We're going to the individual investor or lender, and they're putting the guarantee on it. But those rates are going to be a little higher. The cost is going to be a little higher. And then hard money is basically the next level up, where that's private funding. So that's not something I do. That's really where you're going to more of an individual or an individual group. They don't abide by any they'll have their own guidelines, I'm sure, but those rates are typically going to be much higher. Ours are going to be just a shade below that, depending on the product and what we're looking at. So, but yeah, hard money would be more like with a private investor or a private group of investors that you're just doing it directly through them. There's no other outside agency involved. Yeah. Good questions so far. Any other questions before I move on? Sweet. So bank statement, the reason I threw that in, that can be applicable to actually both primary and investment properties. But that is where we specialize more for self-employed clients, or clients that let's just say they're going to have a tough time demonstrating their income on a tax return because they have great accountants. So what we do is we actually look at their bank statements and we actually see the deposits going in. And we have an algorithm we can plug that into to derive a much higher income than what we would probably see on a tax return. So again, looking more at your self-employed 1099 clients, that can actually be used for either a primary or an investment property. But again, that's something for there. And then blanket loans that's where, again, we're getting into the space of if you have about 3 to 4 properties or greater, we can do one loan for the entire block. So basically, once you're getting to that point, again, instead of having individual loans for each property, you have one loan that encompasses the entire thing under your LLC.
Sort of those, do they all have to be in the same area? Or if you're spread out like state to state?
It doesn't, as long as they're in the same LLC. So it doesn't, so it's not location specific.
Are the rates on those pretty decent?
The rate, I mean, they're going to be a little bit higher typically than like the DSCR loans, but like they're about the same. I mean, slightly higher. Yeah.
Are you seeing more of the 203K renovation loans?
Sometimes, I mean, yeah, and that's, again, I would throw that in the conventional space. So the FHA 203K loan is a great way to rehab a property. It just depends on how much rehab it needs. So those are the type of loans where, let's say, as long as the total renovations and rehab is $35,000 or less, that actually can be a really great idea because you are going to get a little bit of a better interest rate. The down payment, again, is only 3.5%, and that doesn't matter if it's your first, second, whatever. And then the other thing is and that's really more the house hacking strategy, but it still is a great way to get that taken care of. The key with those is you do have to get a contractor to do the work. So you'll see, and we'll talk about the short-term strategies in a little bit, you have to get a contractor to do the work. You can't do the work yourself. They're not just going to give you the money, but they'll actually.
I say I have a contractor locally who needs one for that.
Nice.
They specialize in
So do you have to have them like go through a course, like it can be any contractor that they choose, or is there like a specific group?
It's a specific training, like it had to be certified in, I believe.
Yeah,
Is it state certification, is that?
I think it's the lender.
it's per lender. Yeah.
Okay.
So each lender is going to have their own like vetted list of contractors. And truth be told, even if you're like, you have a guy and you're like, this is my guy, this is what I want to use, we would just give them basically a bunch of paperwork to fill out, and they have to submit, some of their own financials and things like that, just to prove that they're legitimate. And then they go through a vetting process themselves, but they can get approved.
Did you say the max can be $35,000 for renovation?
For a 2 or 3K. Yeah.
Regardless of price point.
Yes, because you'll max out typically the loan amounts on those. I'll have to double check on the loan amounts for FHA because I know they just raised this year. But yeah, it'll be for 203K. They stick to that budget. Any other questions on that? And again, obviously, starting early. Again, that's the biggest thing. Again, I preach all the time about just get on the train. Like when it comes to real estate, it's just about getting started. You don't always have to do it right away. But obviously all of us in the room know that it's not an ideal time for interest rates. We know that. It's actually in a way that gives you a good advantage because we know we're going to be refinancing this soon anyway. So for example, if you've heard of the Burr method, so it's that, again, you're actually part of that is refinancing in a low interest rate market. That doesn't make as much sense unless you're being really quick. But typically, you're going to buy a property, stay in it for a year or two, rehab it, and then when you get that higher value, you refinance. And right now, obviously, you're most likely going to refinance whatever loan that you go into in the next 1 to 3 years anyway. So again, it's a good, easy way to fit into that strategy. And of course, seek out the advice of a tax advisor, but we are not licensed CPAs or tax advisors, but obviously there are tax advantages to writing off the interest on the real estate. So flipping to more of the short-term side, so we do actually have some fix and flip options. We actually have about 3 different investors now. We're bringing on a 4th as we speak, but we do have fix and flip loans or fix and flip lines of credit. So what that really means is typically they can go as long as 18 months. Some, I would say ideally, usually it's a 6 to 12 month deal. Or for our lines of credit, they renew every 6 months. But what that looks like is we're looking at the current value of the property, the current purchase price, what is the budget to rehab it, and then what would you be ultimately trying to sell it for. So the nice thing is for these types of clients, if you're looking at just doing individual projects, that's a great way to kind of get in. And the other thing that's nice, and especially in this type of market, let's say you go through, you purchase the property, you fix it, you're getting ready to flip, you're getting ready to list, and obviously let's just say the market is kind of like it is right now. You're not quite sure if you're going to get the value you think you should get for the property. We have a way that within the same program, they can actually flip it to more of a DSCR product where they turn it into a 30-year fixed loan if you choose to buy and hold. So it gives you that option and that flexibility. So for a client who tries to bring it to market, isn't getting the offers they think they should be getting, they can then flip that into a 30-year fixed loan and just keep the property and kind of reevaluate in the future. But you are going to build it is for a client, you would let them know you're building a very detailed plan with the contractor. There will be draws that do occur out of that. Again, with the loan, it'll be a fixed amount that they'll give you for the rehab, and we'll have already submitted plans, so we'll know exactly what those are. Or with a line of credit, that's really where we're actually taking, before a client would even walk out and start looking at properties, we go through a qualification process. We look at their total asset picture, we look at their credit picture, but it's technically on paper an unsecured line of credit because we're not tying it to a property. We're not tying it to any sort of collateral. So we're usually just kind of leveraging their assets. So for one of our investors, for example, they'll take a look at your entire asset picture and they'll offer you a line of credit for up to 7 times greater. And what that does is it kind of gives you a budget where you can go in and make a cash offer, the client can go in and make a cash offer. They can do all the fix, they can do everything on their own. Again, they will be taking draws, of course, and it is still a process where people are going to be paying attention and they will have something that is being regulated. And you are arranging that with a contractor, but it at least gives the client an idea ahead of time. I know what I'm approved for, I know what my cost is, I know what my interest rate is, and those lines of credit, they renew every 6 months. So every 6 months is when you would get that reevaluated.
Is that gonna be like a 203 where the contractor has to be vetted through you, or can the borrower GC it themselves?
They would have to be vetted through the lender. So no, in all of these scenarios, frankly,
So you're hard on.
a little bit below. I mean, yeah, a little bit below, but still, like for example, those types of loans, you're probably looking at, if it's a first time, because we will do this for a very a lot of these loans are more based on your experience, not so much credit or anything else. It's really just based on your experience. So if it's your very first time, yeah, that's going to be your worst pricing and interest rates. They'll get as high as 11, 12%-ish. But with each individual fix and flip that you're doing, you reevaluate every 6 months and they will actually give you better pricing and better rates. So those will start to come down with each additional project that you complete. So, and then the other thing that's nice, those can be done in pretty quick turn time. So if a client does need something fast, we can get it done in 3 weeks. And obviously, like I said, lower fees, lower costs, because realistically, the interest rates don't really matter as much because again, it's pretty short term. They're turning over the money usually within 6 months or so. So that pretty much slows down. And that's the other thing, is the way to kind of bring that to market is searching for those value pockets. using leverage, finding properties for your clients that have been on the market for a while, maybe been falling in and out of contract for a few times, kind of seeing what those issues were, and then finding those ways to add some value there. So that's about it. I mean, like I said, I kind of tried to keep it fairly high level. I know that was a lot of information in a short amount of time, but my hope is that obviously if you have any questions, definitely want to be able to help and go from there.
All right, so hard money.
Yeah.
Apparently there's new guidelines going in. So you burn at the house, right?
Yeah.
Used to be able to cash out a refi in 6 months.
Yep.
Is the seasoning period actually becoming 12 months now?
So
If you wanted to go conventional, not DSCR.
if you wanted to go conventional, yes, you're going to be, it's still 6 months right now.
Okay.
It may be, well, there's a lot of things that are changing right now in the conventional space, like in terms of these additional costs coming for certain things, but the seasoning period as of now is still 6 months. I haven't heard 12 months yet, but there have been.
So that's not set.
Not set, no. But with, actually with one of our, so with that fix and flip investor I was talking about where, again, you bring it to market, don't exactly get the value that you want, that there is no seasoning requirement for that. So it just needs to be, again, they reevaluate every 6 months, but there's not like a seasoning requirement.
For DSCR, what's the rate, or not rate, but the penalty for refining out there? Because most DSCR is like a 5-year term, right?
You get to pick that. So it can be anywhere from 1 to 5 years for prepay. I mean, you can do a no prepay, but your no prepay on that, the rates are going to be in the 9s and 10s. If you do throw on a prepay on there, anywhere from 1 to 5 years, the greater the prepay, the lower the interest rate. I typically try to stick between 1 and 3, because especially in this rate environment, we're going to be refinancing most likely within 1 to 3 years, so I try not to leverage that too much. Even with a 1-year prepay though, with 25% down, you're still going to get into the mid to high 8s. Okay. So
What's typically the fee if you try to get out of it?
they'll do anything from like 90 days interest to I've got one investor that'll do 6 months worth of interest. But yeah, they'll hit you for usually a certain number of days for interest per day. They'll just calculate it and they'll just hit you that way.
They're gonna get their money.
Oh yeah, they're gonna get something for sure. But it also just depends on whether it's the length of your prepay, how long. Like if you're 3 years into it and you try to get out 6 months in, obviously the penalty's gonna be a lot stiffer than if you're 2.5 years in. So yeah.
Okay.
Good questions. Any other questions, thoughts? Anything that anyone here can help?
Okay, so
Yeah.
What's the conventional wisdom around how many properties or how much value of properties goes into an LLC these days?
Well, so I think, typically like on a conventional scenario with an individual, you can't have more than 10 properties underneath your own social security number. So once you reach 10, you're gonna have to find ways to get outside of that anyway. Typically though, LLC, and again, this I would probably defer to a real estate attorney on the specifics of this, but liability wise, I think typically once you get above 3 to 5, I mean, you're looking at some situations where you might have issues with renters, and so it may just behoove you to look at that. The other thing is taxation wise, you're again looking at working with a tax advisor on that one, but depending upon your current income situation, it may make sense to file underneath an LLC. So again, just totally depends on that, but conventional standards will not allow you to go more than 10 properties underneath your own social, or I should say 10 properties with financing. You can own as many as you want free and clear, of course, but with a loan on them, they max out at 10. So generally speaking,
So you're blanket loan, right? So
Yeah.
you're max out at 10, right? So you put 4 on the ground. and the blanket clears up four again for you.
Correct. Well, anytime you place loans into an LLC that has a separate EIN or a separate identification number that's away from your social, that does free up your personal balance sheet. So you can then acquire more properties through that. So that blanket loan or not, you can just put everything into the LLC if you want to. Amber?
I was just gonna say, for an LLC standpoint, even if you're using your own social security number for the financing piece, having each home in an LLC will protect you in a way that you cannot quite understand. So
Yeah.
I find a lot of the newer folks into the industry don't really know that, so it can protect you from losing your entire empire.
Yeah, that's the thing. I think just from a liability standpoint, I think it's a really, really good idea. Just because they can, if renter slips, falls, blah, 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 whatever happens, again, it's always the doomsday scenario. They cannot go after your personal wealth if it's in an LLC and it's separated.
Or the other homes either.
Or, yes, good point.
I worked with a guy who did not, he had some properties under his social, none of them in the LLC of any kind. And one property he had a slip and fall, took all 10 times. Of his personal assets. So,
Which defeats the purpose of this entire presentation.
that's right.
Now all the wealth is gone. And there you go.
Are there any disadvantages to having it under the LLC, like when you go to refinance, because it's considered then commercial if you're an LLC, or am I maybe not understanding that right?
That's okay. You can have properties underneath an LLC. That does, again, that's more of a lender specific or investor specific guideline. Like some will not do it if it's underneath an LLC, or it is, it adds some paperwork for sure. There's no doubt about it. It's going to add some paperwork. So that's why sometimes it is easier to do it under your personal and then quit claim it into an LLC.
Right.
But ultimately, beyond paperwork, it's not like it just depends on the lender. There's a question.
Yeah, so when you do like a blanket loan, can it be like two, like if they're in two different states? Or does it have to be like 3 or 4? Like, can you?
So it's just a minimum of 3 properties to do a blanket loan, but it's not location specific. They just have to be in the same entity. So the same entity, the same LLC, same, however you have it, that entity set up, they just have to be underneath the same entity.
So going with that, you have all your properties under their own individual LLC. Right?
Okay, like each property has its own
Yeah,
LLC?
so you've got like 1, 2, 3 Main Street, 4, 5, 6 Main Street, whatever.
Yeah.
If they're all under a trust, then all under one trust, does that count as one entity? Again,
That I have to get back to you. That's a really good question.
because that's just like another layer of protection. It's
Yeah.
if they're all separated in LLCs, then you put them under a trust.
That's a really,
So you're gonna make your taxes more complicated.
for sure. And you're gonna make your loan more complicated.
But
still,
then, that's a
really
lot
good.
harder, like you mentioned slip and fall, like now you've got multiple LLCs to take apart and you've got a trust. Like,
Yeah.
If their tenant's attorney is gonna have to be really freaking good.
Yeah.
Super good, right?
Yeah.
Super good. Like,
If you have all those relations under like
I
a
don't know.
parent.
Yeah, and that's maybe I would probably go with that more than
That
anything
works
else.
a lot.
But no, the trust question is still a really good one, so I'll have to find out. I don't know off the top of my head, but that's a good one. So I'll get back to you.
It's kind of also a good idea to have like an umbrella liability policy for like your total net worth to protect all those properties, because that would come into play usually for
You're
those other 6
right.
houses, but yeah. And you can get those up to 10 million or more if you need.
For oddly pretty cheap. Like to add an umbrella on your insurance is pretty cheap.
Yeah,
Compared-
like 1
The
million.
losing compared to losing your house.
Yeah.
Like 1 million on a personal umbrella could be anywhere from $200 a year to $400 a year, but it also extends to your car and layers on top of that. So if you're in a really bad accident, you're the one at fault, and you injure a family of 4. You could go through your $250,000 per person or $500 per accident like that, and you're really
Yeah, so what's an extra $20 a month for $1 million?
Yeah.
You also have to consider too, along the lines of insurance kind of things, is if you're in a partnership, even a husband and wife partnership, are you protecting each other? Because if one of you dies, what happens? If you have 10 separate loans under combined socials or single socials. So just keep those types of things in mind, is not only ensuring first and happens while you're alive, but if one of you happens to die suddenly, I've seen people lose their hybrid rental property, their wife is just stuck with, or the husband is just stuck with their primary is what they end up after having 15 or 20 of those loans. So making sure that you have it set up so that you can cover those loans in the event of one of you dies.
And that's why estate planning is important.
Yeah, estate planning, succession planning, if you're, again, that kind of stuff is absolutely crucial. So, yeah. And obviously, these are the kind of problems that we want to have. If you're in that position, these are great things. But again, whether you're just getting started or you're, had some experience doing this and looking to grow, there are definitely ways to do it. And obviously, that's all I got, but I sincerely, sorry.
Yeah, in your experience, do you have any creative strategies that you've seen investors that are just the average, not, born into wealth or anything, but just the average family that's doing stuff creatively to start, building this at a faster pace than like a Burr method might or something like that?
Okay, well, and yeah, certainly I would say, so the first thing, truth be told, the house hacking or the Burr method is probably just a great way to get started. You're right, it is more of like a 1 to 2 year play and then get the next property and move on. Beyond that, it's just really finding ways to grow your assets, frankly. Unfortunately, there's not much we can do in terms of the down payments. So that's really where I've seen clients who maybe they have some cash, but not enough cash, and finding, pairing them with people who can help grow those assets a little bit faster. For example, there's people in the room that might be able to help with that. So it's definitely, let's just say, let's stick around and talk afterwards, because, yeah, go ahead.
Are you finding that a lot of folks in the state are using the FHSA at all?
Say that again?
FHSA,
Okay.
are you seeing a lot of those for down payment savings?
So, we have different down payment programs. I'm not familiar with that one, but we have everything from like your typical, like Chaffer programs, CHAC and Genoa and all that sort of stuff in terms of, again, that's kind of along the house hacking side to minimize the down payment. The reason why I do like that is even if you have the extra funds, it at least gives you that opportunity to hold some back. So again, you're planning for the future. That's the other thing that I would say is, if you have a client who maybe has more, but is interested in investing, that's really simply where maybe looking at the difference in strategy of taking on down payment assistance or something along those lines. That won't add too much to your payment. It will be forgiven over time if they stay in home, but then it allows them to then go purchase a different investment property and save money for that. So that's the other thing of just getting a little bit more strategic. But
DSCR, do they have a maximum on doors you can buy? Like, can you go after duplexes, fourplexes, 10-door buildings?
you can, I've got one that will go up to 10 units.
Okay.
So it's, at that point, you're kind of getting more into like the commercial space. And so there is some hybrid products that they're kind of doing. It's a commercial product, but making it more residential.
Is it less lucrative than commercial? Yes.
What do you mean less?
So
So you
like-
mean like better pricing?
Yeah, like is it
It would be better pricing for that than commercial. But the other difference is those types of loans will allow you to do like a 20-year fix or a 30-year fix, whereas most commercial, they won't go much beyond 20 years. If they go 20 years.
Yeah, usually it's like 10.
Exactly. They'll amortize it over 20 years, but it's really more of a 10-year product. Whereas the residential will allow you to extend that out to that 20 or 30 year. But yeah, once you start getting north of 10, it's pretty much going to be a commercial. Commercial. And we do some small amounts commercial as well, up to 2 million. But yeah, again, you're definitely more in that space.
What are you seeing for down payment requirement for over 4 units?
4 units, same thing, no different than anything, so like 20 or 25%. Idea, and again, it just depends on if you're going conventional or going the DSCR route. Are you thinking more like conventional or?
Yeah,
So it's still 25.
so you can do a 6-unit conventional, or can you only go up to 4?
They can do a 1 to 4, and then there's a 5 to 8, but
Okay.
yeah, and the down payment it does increase it to 30.
Okay.
Beyond that. Yeah, same sort of.
So do you think on, like, strategy-wise, with the rates being where they are,
Yeah.
you know, in a recession, once we get out of it, rates should come back down historically. Do you think strategy-wise it's better to go with the, not minimum like 50% down, but like a 20% down versus 125, knowing you're gonna refinance anyways and save some of that cash?
So that's kind of where, so when I'm, just having those strategy sessions with a client, I'll ask, one of the questions I'll ask is, what's more important to you, the overall cost of borrowing or the interest rate and monthly payment and cash flow? And that's really where we kind of evaluate the two. So it just, ultimately, I would argue that I want to keep your costs down as much as possible, knowing that even if you're taking a higher interest rate now, it will ultimately, again, within, let's just say, 1 to 3 years, you're going to be refinancing that and getting that into a better place now. But at least you're going into a market where there's areas of opportunity. There's going to be some these value pockets where there's, again, we are starting, at least for me, and again, I throw it to the rest of the room too. I'm seeing buyers come back. The activity's well up than what it has been over the last 2 months. So we're starting to kind of get back into that, but the more, when we can take advantage of that, when it's more of on the buyer side, I'd rather get somebody in now, try to minimize their cost, and not worry so much about the interest rate, but knowing that that will ultimately be better in the long run. And also when you refinance, again, in 1 to 3 years, your value most likely will be higher. You'll have more equity, which actually will be more favorable for your loans, right?
So if you cash out refi, if you were to do that,
Yeah.
say you put 20% down, wait 2 years, then you do a cash out refi, and you're still gonna stay at 20% down mark.
Okay.
There's still a hit for doing cash out refi though.
Well, there's always going to be a hit for cash out refi, and it just depends on what you're going up to when you actually get the cash out. That is some of the things that are changing. That I do know is happening. There's a lot of lenders that are pushing back on it right now, but I don't think they're going to win. But point being, there is going to be some penalties for sure, more than what there used to be. So it just depends on how much cash they're getting and what value they're getting for their loan and what are we going up to. So are we going back up to 20? Like let's say they're at 30% down and we're going back up to 20. It depends on the situation. But it generally though is just an overall, that will be lower cost than doing the purchase. So, anything?
Well, thank you, Connor.
Yeah.
It's right here. Thanks everyone for coming. Feel free to hang